Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news of an unexpected threat to some retail dairy trade with China. On Friday, a new tax law in China came into effect on e-commerce trading and duty-free entry points into the country. As part of its implementation, the country's authorities issued a safe-harbour list of permitted products, but whole milk powder and UHT milk are not on the list. In fact, many things are not on the list, but these two affect New Zealand directly. Travellers returning with them need to abandon them at the airport. But we should note that infant formula is not affected. It is on the list. Websites selling non-listed products directly to consumers have pulled them from their services, and that includes dairy products. The situation is a bit chaotic at present. The new law is specifically designed to tax cross-border trade to the advantage of local manufacturers. However, wholesale channels are unaffected, neither is using the official China Post channel apparently. You do wonder how this ban works with our FTA agreements in the way it has shut down the e-commerce retail channel for affected products cold. There will be no doubt a whole lot of behind-the-scenes activity going on at the diplomatic level, but much more than New Zealand's retail milk trade is affected, so how quickly and sympathetically things get resolved is very unclear. The perils of dealing with an all-powerful one-party state where the rule of law means something different to what we imagine. China denies there is any problem. Staying in China, consumer inflation held at 2.3% year-on-year in March and unchanged from the rate in February. But eyes will be drawn to the 7.6% rise in food prices nested within the overall data, which was an unexpected jump. A shortage of pork is behind the rise. On the other hand, producer prices fell 4.3% year-on-year, but that is the slowest decline in a long time. Month on month, China's consumer prices actually rose 0.5%, their biggest climb in over 2 years. And in Australia, Moody's is warning that because yields have fallen so low for residential investment properties in both Melbourne and Sydney, there is rising risk in these investor markets. The deteriorating affordability of servicing investment properties makes residential property investors more vulnerable to risks such as loss of income, interest rate increases, vacancies or rent reductions, and therefore increases their probability of default, they say. Yields in New Zealand, especially Auckland, exhibit very similar vulnerabilities. In New York, the benchmark US Treasury 10-year yield is unchanged at 1.72%. The oil price is still rising. It is now over $40 a barrel in the US, while Brent is now just under $43 a barrel. The gold price is also up, with a $14 rise today at $1,256 an ounce. And finally, the New Zealand dollar starts today at the upper end of its range, having risen overnight to 68.6 US cents on a weaker greenback, 90.3 Aussie cents and 60.1 Euro cents. The TWI is now at 71.5. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.